Hello and welcome to another deep value video. Today taking an in-depth look at Colgate-Palmolive Company, ticker symbol CL. We'll dive into the financial metrics, assess the company's growth, and ultimately try to find its fair buy price. The Colgate-Palmolive Company, commonly known as Colgate-Palmolive, is an American multinational consumer products company headquartered in New York City. The company specializes in production, distribution, and provision of household healthcare, personal care, and veterinary products. The stock is priced at $99.7 with a market cap of 81.5 billion. Now let's dive into some key valuation metrics. The price to earnings ratio stands at 28.5 and the price to cash flow ratio stands on 20.5. The BDM PE over the past 10 years was 27.7, showing us how the market usually values Colgate. Over the past 5 years, the company's revenue has grown by 24% and its bottom line has decreased by 2.8%. In terms of earnings per share, there has been a growth of 0.1%, and notably, the number of common shares outstanding has shown a minus 4.1% decrease to 826 million. Now let's assess the company's liquidity and solvency. The interest coverage ratio is 14.5, indicating the company's solid ability to handle its debt obligations. The quick ratio, a measure of the company's short-term liquidity, is 0.7. This suggests a moderate ability to handle short-term shocks. And additionally, the long-term debt-to-equity ratio is 16.9, and the total debt-to-equity ratio is 18. Now, these may seem very high, which they are very high, but that is for a good reason, because they have done a lot of buybacks and their treasury stock is pretty big, so that decreases their equity. Uh, so this is not something to worry about. Their debt to equity ratio being this high is sort of an artificial thing. This is mainly basically only due to their buybacks. So you should not really worry that much. Shifting to the cash flow statement, cash from operations stands at 3.74 billion, reflecting a growth of 19.5%. Cash from investing activities is minus 740 million, with a minus 64.6% change, while financing activities are at minus 2.8 billion, showing a plus 221% change over the same period. CapEx has increased by 110.4%, and free cash flow has grown by 21.9% to 2.9 billion. Moving forward, let's look at the return metrics, how the company is utilizing its resources. The return on equity is 461%, but as I've mentioned, they've done a lot of buybacks and their treasury stock is very big, so that decreases their equity. So this is artificially high. Their real return on equity, excluding treasury stock, is much closer to 20%. The return on investment is 47.5%, which is very good, and the return on assets is 17.3%. Most crucial of all, the return on invested capital stands at 29.6%, a very good show of health and strength for the company. Finally, let's find the acceptable buy price. The first method is conducting a discounted cash flow analysis. By using a discount rate of 10%, a revenue growth rate of 4.5% for 10 years, and a perpetuity growth rate of 2%, we get a fair value of $57.15. Secondly, using a multiples variation of 20 times earnings, operating cash flow, and 25 times free cash flow, we get a fair value of $85.5. And thirdly, the analyst price target is $107.7. Putting it all together, we arrive at an intrinsic value of $83.4. And as Benjamin Graham used to do it, and will continue, of course, uh, using a 15% margin of safety, we get an acceptable buy price of $70.9, suggesting that the stock at the current levels is overvalued. To wrap up my analysis, I rate Colgate-Palmolive as a whole because this is not really a growth play. This is not really a value play. This is more of a dividend play. So I'm not really, I don't really specialize in dividend plays. Um, I think that the whole dividend community has their sort of little niche in investing, and it's worked for a lot of them. It's sort of like value investing, but instead of looking for DCFs and price to earnings, you look more to dividend payouts and so on and so forth. And I rate it as a hold only for those that have bought it at, I don't know, sub 60, sub 70 levels. because it's a great company, and if you bought it at less than 60, you will already have a 2.5, 2.7% dividend yield, which is safe and will slowly grow through time. Now, as for growth investors or value investors that don't really look at dividends, they only see them as a bonus. This is not really a buy. This is more of a wait and see kind of investment. Now, as we've seen from their ROIC, from their ROA, ROI, from their free cash flow growth and their capex and their buybacks, we can see that this is a well-run company. They have good management, but the only thing that's missing here is the value. The price is just a bit too high. If the price managed to drop to sub 55 levels, sub 60 levels, then this would definitely be on my wish list. But for now, this is a bit too much for me. I hope you enjoyed the video. I hope you found this video helpful. Uh, if you like and subscribe. If you don't. But if you like and subscribe, you will manage to get more news, more deep value analysis from me, the great presenter. And to end the video, thank you for watching and see you next time. Bye.